Today, we will introduce China's financial market and explore its key structure, trends, and how it connects with real-world companies. Our case study will focus on BYD and Bank of Xi'an. China has three main stock exchanges: Shanghai, Shenzhen, and Beijing. Shanghai focuses on large state-owned enterprises. Shenzhen supports fast-growing tech firms. Beijing was created to serve small innovation companies. These exchanges form a three-tier market system supporting companies for all sizes. And this is our group member. And let's go to the next page. To deal with growing economic pressures, the People's Bank of China, or the PBOC, has adopted a series of easy monetary policy. For example, in May 2025, the central bank cut the reserve requirement ratio, or RRR, by 0.5%. Releasing over 1 trillion yuan into the banking system. These moves aims to increase liquidity, making it easier for banks to lend to companies and consumers. In addition, China is actively promoting green financials. That means encouraging banks and investment firms to fund environmentally friendly sectors like electronic vehicles, solar energy, and battery technology. The goal is to guide capital toward industries that align with China's carbon neutrality plan by 2060. This green financial strategy not only helps the environment, but also opens up new financial opportunities in the global market, positioning China as a leader in sustainable development. Right now, China's economy is going through a period of adjustment. There are three major challenges. First, overcapacity in the EV, solar, and the battery sectors. Too many companies are producing the same things, which leads to falling price and waste resources. Second, high level of local government debt. Many cities and provinces borrowed heavily to fund infrastructures, but are now struggling with repayment. 3. Capital outflows. As the United States rise interest rates, global investors are pulling money out of China and putting into U.S. market, where returns are more attractive. In response, China is focusing on domestic consumption, encouraging Chinese citizens to spend more. It also aims to strengthen indigenous innovation, reduce dependence on foreign tech, and build a self-reliant economic system. This transition is difficult, but it's necessary for long-term stability and global competitiveness. The capital market plays a vital role in the Chinese economy. It allows companies to raise funds through two main methods: issuing stocks, where they sell ownership shares to public investors; issuing bonds, where they borrow money from the public with a promise to repay with the interest. When a company's stock price rises, it sends positive signal to the market. It shows confidence from investors, making it easier for the company to attract a new capital. But that's not all. Stock price movements also affect how much a company can borrow and at what interest rates. If investors believe in the company, lenders are more willing to offer loans at lower rates. On the other hand, central bank policy like interest rate cuts or RRR adjustments will influence the cost of borrowing for businesses. A lower interest rate environment encourages companies to expand, invest, and innovate. In short, capital markets are not just about trading. They are deeply connected to real-world business growth.
Let's look at a real-world case. BYD, one of China's top electric vehicle manufacturers. BYD is listed on the Shenzhen Stock Exchange, meaning it raised capital by issuing shares to public investors. In addition to equity financing, BYD also issues corporate bonds to support research, development, and factory expansion. But what's more interesting is how BYD combines financing with its sales strategy. In 2014, it partnered with the Bank of Xi'an to establish BYD Auto Finance Company. The goal to offer auto loans to customers, making it more affordable and increasing sales. In this joint venture, BYD holds 80% and the Bank of Xi'an holds 20%. Their model is simple but effective. Offer low interest loans to EV buyers. By doing so, they lower the financial barrier for customers and stimulate both car sales and bank business. This is a great example of how industry and finance can collaborate to build a win-win ecosystem. This partnership delivers three major results. It boosts BYD sales by offering customers flexible loan options. It helps Xi'an banks by building a stable portfolio of auto finance sales, improving long-term income. And most importantly, it shows how financial innovation can directly support the real economy. It's not just about numbers, it's about strategy, structure, and sustainable growth. So where does the People's Bank of China or PBOC come in? The central bank plays a guiding role by cutting interest rates and the RRR to improve liquidity, offering target loans to key industries like new energy vehicles, influencing finance costs, which directly affects business decisions and customer loan availability. In short, the PBOC doesn't just set policy, it shapes the environment that allows partnerships like BYD and Xi'an Bank to succeed. To sum up, Chinese financial market is transforming rapidly. It's no longer just about big banks or stock exchanges. It's about interconnections. The BYD and Xi'an Bank case shows how capital markets, bank, and real industry can grow together. By understanding these links, we can better grasp how financial policy shapes corporate strategy and how innovation drives both.